Well, hello, good evening, good morning, good afternoon, good night. Good afternoon. I am your host, Dr. B. Welcome back to Principles of Accounting 2. We are currently in the third week of the 6-week course during the summer 2022 semester, term, whatever you want to call it. Today we're talking about cost, value, and profit analysis. Before we get started, I just want to quickly recap where we are in the classroom. Weeks 1 and 2, you found those in Module 1. Currently in Week 3, which is found in Module 2. So if you go ahead and open up Week 3, you'll see the cost value profit analysis PowerPoint presentation, the exercises that accompany this discussion. Homework assignment for this discussion on cost value profit analysis are 5 questions, mix of true, false, multiple choice. You have 2 attempts on the homework assignment, as you always do. And also, the midterm exam is also due this Sunday night. My God, Dr. B, what are you doing to me? Midterm exam! Oh my goodness, it's already here. Yeah, I know. Week 3 represents the middle of the term, right? Because it's only a 6-week course. So the midterm exam covers chapters 17, 18, 19, 20, and 21. We started with 17, right? Pretty sure. Yeah, we start with 17. So 17, 18, 19, 20, and 21 are on the midterm exam. For those of you keeping track at home, that's 5 chapters. 5 chapters, it's 20 questions. It's a mix of true, false, multiple choice. What does it mean exactly? Well, it means that on the midterm exam, that is a mix of true, false, multiple choice, covers chapters 17, 18, 19, 20, and 21, means that there's 2 questions per chapter. Quick back the envelope math. Well, you know. So if it's 20 questions, I mean there's 4 questions from each chapter. The midterm exam, it's worth 20% of your total grade. I know that stings, right? Here's the good news. As long as you do the homework assignments and quizzes in chapters 18, 19, 20, and 21, and I strongly recommend that you go through the exercises, hint, hint, you'll probably do very well on the midterm exam. Why? Because the questions that you saw on the homework assignments and quizzes are similar to the midterm exam. That's awesome, right? Yes. Well, thank you. No, I appreciate you saying that. Yes. Uh, I try. uh, so So yeah, that's the midterm. We'll talk about the midterm exam after we talk about cost, value, profit analysis, which is why you are all here. So without further ado, let's go ahead and jump into the presentation. I'll of course give you real life examples along the way. We'll talk about the formulas. I know the formulas can be somewhat tricky, especially for this chapter. And also, I just wanted to go through the process and talk about this. It's a very important concept. Cost value profit. Now, here's why it's important. In business, you got to know how to break even. Break even is so important. What does it mean, break even? Break even means, very simply, it means you neither made a profit and you did not make a loss. You end up with zero. You're net zero. What does that mean? It means that you sold enough products to cover your expenses. You didn't make enough profit, but you also didn't make a loss. That's break even. Okay, you sold enough products to cover your expenses, but you also didn't make a profit. You also didn't make a loss. That's what break even means. Okay, and that's what we're going to talk about today. Cost, value, profit analysis. Simply put, we look at ways to sell enough of our products to cover our costs making the product, but also some selling and administrative expenses. So we're going to talk about those types of costs. From a volume perspective, it simply means how many units I need to sell in order to break even. And then profit analysis simply means how many units do I need to sell to generate a profit? So we're going to talk about those things. We'll talk about margin. We'll talk about
Professor, I don't
yes,
know why. Yeah, I don't know why today you sound a little not as clear as you usually do. It's a
not as
little muffled.
clear. Okay, I'm sorry. Let me see what I can do with. Um, Again, the technology, right? Am I going like in and out? Is it,
Yeah,
It's just like sort of echoey.
yeah, it sounds like something is obstructing
Yeah,
your
you usually
microphone.
are a lot clearer.
Interesting. Let me fiddle with this microphone here. A little echoey. Okay. Hold on just a sec, y'all. Let me fix this real quick. I am going to pause and then let me do this. A little echoey. Okay, let's see what I can do. Audio. Let me try this. Hold on just a sec. And my audio. And the microphone. You said it's echoey. Okay. Echoey. Let's see. Noise removal. Optimize my voice. Background noise enhances all voices nearby. Optimize. Okay. How does this sound? Can you hear me okay?
Yes, I can hear you.
Is it better or worse? Or the
It's
same?
about
Okay, Sinead.
It's kind of sounding the same. I'm wondering
Same?
if you're using an external microphone, you might try taking it out and plugging it back in.
Really? Yeah, let me try that.
No, that's not it.
That's actually a lot better.
Is
yeah,
that
that's
better?
actually better.
Yeah, that's a lot better.
Really?
Yeah, whatever you just did.
Okay. Sinead, better?
No, never mind. It's
No,
back.
now it went back out. Whatever it was.
Same or better?
Keep
Can you say
testing.
Same.
1, 2, 3. Same or better?
Same.
Yes, that's the
Same?
same.
Well, good. Okay, same or better?
Yeah, it's still the same. I don't know. Whatever you did the first time when you were trying to fix it, that worked for a second.
Okay, same or better?
That's better. That's
better?
right.
Okay.
That's
I unplugged the webcam, so whatever. It's better though, right?
yeah, a lot
right.
better.
Okay. I'm cool with that. I don't
Actually
care.
perfect.
All
Yeah.
right. They must have been the webcam getting all jacked up. All right, cool. Thank you all. Appreciate your patience. Yeah, last thing I want is it to not sound right because this is important stuff. All right, here we go. Let me start again. So, as we're saying, with respect to the cost, volume, profit analysis, we're looking at the concept of breaking even. Breaking even is not just did I cover all my expenses? It's a little bit more than that. And we're going to talk about concepts like profit margin. We're going to talk about concepts like covering costs, how to understand did I cover my costs, and a concept called target profit. Target profit's interesting because it's kind of like this is how much I want to make in profit. And I'll show you how to build that into your formulas. And for those of you who are business owners, and I know there's a few of you in the class, this will be a kind of a fun exercise for you because you can apply it to your business. And you can apply this to any business. It's not unusual to be able to do that. So let's go ahead and talk about this. And I'll also give you a couple of examples. So first, cost. Cost, volume, profit. We got to talk about cost. Understanding our costs of manufacturing. And we've been talking about this for the past 2 weeks. We talked about the cost of manufacturing. We have 3 primary costs that go into making a product. We have direct materials, direct labor, and factory overhead. These 3 components go into making a product. And understanding those 3 costs that go into making a product, we can determine how many units we need to sell to break even. That also means we need to understand how to set the sales price to determine how many we need to sell to break even. So, understanding the costs that go into the product and understanding the sales price will help us to understand how to break even. So, how many units we need to sell to break even? That is the biggest factor in business. It really is. Because if you don't sell enough, you're going to lose money every month. If you don't sell enough units that cover the cost, you'll end up with a loss. If you sell more than enough units to cover all your costs, you'll end up with a profit for that month. So that's why it's so important to understand break even. When our income changes, we can make investments into the business. Or we can use investment capital to purchase machinery. Now, if I purchase a piece of machinery, what does it do to my labor costs? One would think that the machinery would assist the employees. And what that means is our labor costs will go down because our employees would be more efficient because machines are helping them. Oh, this next one's one of my favorite. What happens if there's a change in the sales price or a change in the amount that we're selling? Oh, that's a good one, right? So think of it this way. Let's say we manufacture computer microphones, for example, okay? And we sell our computer microphones for, we'll say $50. And it costs us, we'll say $20 to make. Costs us $20 to make the microphone, direct materials, direct labor, factory overhead, $20 total to make 1 unit, okay? We sell for $50. That gives us a profit margin of $30. Sales price minus your cost of goods sold or cost of goods manufactured. Sales price minus the cost of good manufactured, total cost of the product, equals your gross margin or your margin, right? Now, if I sell for $50 and it costs me $20 to make, that gives me a $30 profit margin per unit. Now, if I decrease the price, let's say I put it on sale for, we'll say, $40 per microphone, that will also change my margin. My margin goes down to $20, right? 40 minus 20 is 20. Sales price minus the cost of the product equals the margin. Now, what does that mean for the sales volume? If I reduce my sales price, in most cases, I need to sell more to break even. If I increase my sales price, I bring it from $50 to $60, that means I increased my profit margin. I can sell less units to break even. Understand? You understand the relationship between the sales price and the number of units you need to sell to break even? Is that clear through that example? What do you
Yes, sir.
Peter, you good? All right, cool. So I'll break it down further. We'll look at the formulas and we'll plug them in. But there's a strong correlation between the sales price and the amount you need to sell in order to break even. Higher the sales price, less you need to sell. Lower the sales price, the more you need to sell. Typically. Doesn't always work that way, but in most cases it does. What happens to the income with those changes? It depends. It depends on a couple of different factors. But if we're looking at it from a numbers perspective, if I raise my sales price, I would think my income would go up. If I reduce it, I would think my income would go down, which is true to a degree until you've reached the break-even point, and we'll talk about that. And the last one on this list here is what I referred to earlier as target income. Target income is the amount of profit I want to make. So if you have a goal in mind, let's say you just started a business, all right? And you have got a target income. You want to earn $100,000 a year. That's your profit target, right? I want to earn $100,000 a year. Great. That's a great goal, okay? So how many units do I need to sell in order to earn that target income? Awesome question. And we'll talk about that concept by applying the formula. So let's talk more about costs. As we talked about last week, there are fixed costs and variable costs. Fixed costs are costs that do not change regardless of the level of output. That's what a fixed cost means. It's fixed. It stays the same. It don't matter if I sell 30,000 units or no units. My rent still needs to be paid every month. It's fixed. It's the same amount of rent every month, okay? It don't matter if I sell 10,000 units or 4 units. My manager's salary's the same. I still got to pay my manager. Okay, it's a fixed cost. These are examples of fixed costs, right? Fixed costs do not change regardless of the level of output. That's what fixed means. Variable costs, on the other hand, change with the level of output. Variable costs change with the level of output. What do I mean? Well, if I manufacture 10,000 units versus 2,000 units, I got more direct materials, more direct labor, more factory overhead, more electricity bill, more etc., right? My costs vary with the level of output. That means that's what variable cost means. But I want you to understand these costs in totality. Okay? We talked about fixed costs and variable costs. I want you to understand them as they relate in totality. Total cost. Now, here's the thing. We know that our variable costs change with the level of output. However, the total cost of manufacturing a product doesn't really change. Now, let me explain it. Take a look at this top chart here. When I mean totality, I want you to think about fixed plus variable costs, total cost. Fixed costs remain the same regardless of the level of output. This is represented by the dark orange, reddish line going through the center of this chart, about $32,000. $32,000 is my fixed cost. That includes things like the manager's salary, the depreciation expense, the rent, etc. Fixed costs, they don't change. My variable costs are $20 per unit. Remember, that's direct materials, direct labor, factory overhead, $20 per unit. That $20 per unit remains the same. What's variable is the number of units. Okay. The variable costs remain the same. What's variable is the number of units. My direct materials, direct labor, factory overhead per unit remains the same. $20 per unit. What changes is the number of units. Okay. So take a look again at the chart on the top. You'll see the lighter orange, almost yellowish line. It says variable cost equals $20 per unit. And you see it goes upward and to the right. It represents the increase in variable units as more units are sold. That's what makes it variable. Okay. Remember, the variable cost per unit remains the same. It varies based off of the number of units, right? So $20 per unit goes up as more units are sold. And my total costs also increase based off of the number of units sold. Now take a look at that chart, and that's at the top there. See that green line? That green line represents the total costs. Total costs are fixed costs plus variable costs per unit. Okay. According to the break-even part, we need to be able to cover our fixed and variable costs. That's how we break even. And we'll talk more about that here in the next few slides. So that's the relationship between fixed costs and variable costs from a general perspective. With respect to total cost. Everyone understands total cost, fixed plus variable?
Yes, sir.
Awesome. Thank you, Peter. Okay, so now let's take a look at the bottom of this slide. We see this second chart. This second chart shows us what happens on a per unit basis. Okay, this is where some students get confused because it still says total cost, but it's total cost per unit. So on the top slide, part of the slide, we talked about totality, total cost. On the bottom part of the slide, we're talking about per unit basis, okay? So per unit. I want to show you a couple things, okay? So per unit, we said that the total cost per unit is $20 per unit. That $20 per unit represents the variable cost per unit. Variable costs are direct materials, direct labor, factory overhead. Direct materials, direct labor, factory overhead per unit is $20. That remains the same regardless of the level of number of units I produce. It's still going to cost me $20 per unit. I make one microphone for $20. The next microphone I'm going to make, guess what? $20. The one after that, $20. My variable cost per unit stay the same, for the most part. So it's $20 to make it. That's it. It doesn't matter if it's today, tomorrow, it's the same. So $20 per unit is our variable cost per unit. We can see that in the yellowish, light orange line at the very bottom of the bottom chart. Now, here's where students get tricked up, and I want you to understand this very closely. We're talking about per unit. Per unit. What this means is we're applying the costs on a per unit basis. Now, let's take a look at our fixed costs on a per unit basis. We can see, and this is represented by the dark orange or red, it's downward sloping into the right, which means that the more units I produce, my fixed cost per unit also decreases. I can hear you, Dr. B. I don't understand why it is that. Now remember, this is on a per unit basis, okay? So my fixed costs are $32,000 in this example. My variable cost is $20 per unit. The more units I produce, the less fixed costs I apply per unit. A way to think about that is you take your total fixed costs and you can divide that by the variable cost per unit in order to get the total fixed cost per unit. And the more units I sell, the lower that fixed cost goes. So fixed cost per unit, divide that by the total number of units that we sell. We can see that cost comes down with the more units I sell. Make sense? I know that part's tricky. That part's tricky. And I'll show you what that looks like in a little bit here. And of course, our total cost per unit, variable cost plus fixed costs per unit. And we see that our total cost per unit decreases with the more units I produce over time. And that's the relationship on a per unit basis between fixed and variable costs. Now let's look at it from another perspective. This perspective shows us the relationship of variable costs to the total of number of units sold. So we can see the difference between the two slides, right? Let me go back and forth one more time. Watch this. There really is not much of a difference here. In fact, there's pretty much none. And the reason for this is if we look at the trends, the variable costs as they relate to fixed costs gives us our total cost and our total cost per unit. So that's why it's important to understand that relationship between the variable cost and fixed cost. because they represent the total cost as a whole and the total cost per unit. Now I'm going to introduce the last part of this concept, and it's called mixed costs. Mixed costs are neither, well, I'm sorry, not the word neither. Mixed costs are a mixture, that's why I call it mixed, of fixed and variable costs. Fixed and variable costs is a mixed cost. Let me give you an example. Let's say your company decides to rent a printer. I know that doesn't sound very exciting. Let's say you're renting a piece of machinery. All right? You rent this machinery from the manufacturer. Let's say it's a printer. It's a copy, scanner, fax. You know, one of those big industrial kind that you see in an office building. So it's one of those big Xerox machines. And the contract reads like this. It says, well, you can rent this copy, scan, fax from us for a total of $30,000. I'm sorry, $32,000 per year. Okay, that's the fixed cost part. You can rent this Xerox machine from us for $32,000 per year. And that fixed cost will cover up to 30,000 pages. That's the fixed part. Plus 1 cent per page over the 30,000. That's the variable part. So fixed part is the cost of renting the machine for a year, 32,000. The variable part is 1 cent per page over the 30,000 pages. Make sense? That's what mixed cost is. Make sense? You all got that, right? Yes, no, maybe?
Yes, sir.
Thank you, Peter. Appreciate it. All right, cool. Okay. What other cost behavior I want to show you? I'm going to use a different example for this one. And this is probably an example that most of you are familiar with. Your cell phone plan, okay? The plan. Now, some of y'all got money, so you're on that unlimited stuff. Right? Not me. I ain't got no money, so I'm not no unlimited. I'm the guy looking for the Wi-Fi, yeah? So, okay, let me give you an example. The cell phone plan. And the example I'm going to use, this model is called the stepwise cost model. And it shows us that costs increase incrementally, and then they steady out, and the cost goes up, and then it steadies out. Okay, it's called stepwise. It looks like a staircase, right? So here's how it works. The cell phone company will say, hey, we got a great deal. We'll give you 1 gigabyte of data and unlimited calling and text for, say, $40 a month. Okay, great deal, right? Okay, $20 a month. Let's get aggressive. 1 gigabyte of data, unlimited call and text, $20 a month. Solid deal, right? You're like, oh man, yeah, I can do that. 1 gig. 1 gig's not a whole lot of space. It's not a whole lot of data, right? So you're blowing through that 1 gigabyte. So, but the cell phone company's got you covered, right? They're like, hey, no problem. You're going to hit that gigabyte of data. Well, you'll pay us $40 for 3 gigs of data and unlimited talk and text. Great. Yeah, awesome. But some months you're like a real big data user, right? You're like, man, I don't have a strong Wi-Fi, and I really want to watch the game, so I'm gonna watch it on my phone. So you blow through that 3 gigs of data. The cell phone company got you covered. Don't worry about that. So they say, hey, listen, you went through your 3 gigs, so we'll give you 5 gigs of data for $60 a month for the month. Yeah, that's how cell phone companies price. They use the stepwise cost system because, as you know, for cell phone companies, they base a lot of their costs around data usage. Uh, and this is the model that they use. It's called the stepwise cost. Make sense? Good, right? Did you like the example? All right. All right, cool. The other one, another model, is called the curve linear. The curve linear, it's a lot smoother. Okay, it's that nice orange line. It looks like a wave, right? It's a curve. It's a curve linear. It's like a wave. It's the orange line in the graph there. The costs increase with the level of activity, but in a nonlinear fashion. The costs go up incrementally rather than through steps. That's the difference. So curve linear, think of it like a wave. The costs go up a little bit, little bit, little bit, rather than all at once, like in the stepwise system or model. So those are different models. I'm going to show you this. Don't freak out, okay? I know statistics, right? Nobody likes statistics. I don't like statistics. Terrible class, didn't do well, especially a regression analysis. I don't even want to hear that word, okay? I hear you. I know. Believe me, I know. I feel you. I was there. I was that student in stats, and I'm like, man, I don't like stats. I was so bad in stats. Very bad. I was very bad in stats. I hated stats. Statistics was like the worst thing in my college career. Oh man, it was bad. So I'm going to tell you about it, but don't freak out because I'm not going to make you remember or do this stuff. Okay? This isn't that kind of class. Well, let me show you these three models. And the reason why I'm showing you these is because they relate back to cost, right? I need you to know how they work because you'll probably see one, maybe two questions about this on the midterm exam. But I'm just going to be asking you to look, right, at a chart and tell me which one it is. That kind of thing, right? Don't worry, nothing too nuts. Okay, so the first one I want to talk about is called the scatter diagram. So every month, our costs change. That's normal. That's business, right? Our costs are going to go up and down based off of, the electric bill was higher or lower. Um, you know, labor costs higher or lower. Whatever. All the variable costs change from time to time. So the little dots on the screen that you see there, those represent the individual months. January, February, March, April, May, June, July, August, September, October, November, December. And we see those little green dots kind of relatively in line. Okay, in line. We call it in line. There's a couple of outliers. March is kind of outside the limits. Looks like October was outside the limits. Looks like June was too. But we can say that all of our costs throughout the year were what we call in line. That's the line of cost behavior. That's that dark orange, red color there. And we see the little green dots are very close to that line of cost behavior. All this does is what this represents is our variable costs as they fluctuate month to month. And what's the correlation? It's correlated, right? We see that we can draw a statistical line through all 12 months and get an understanding of how closely correlated our variable costs are. That's what a scatter diagram shows us. And we can see the estimated fixed costs for the year. You remember, fixed costs don't change throughout the year, but the variable costs do. And this is a line of cost behavior, shows us the correlation between the variable costs for each month. The next method I want to show you is the high-low method. Now, this one will show up on your homework assignment, okay? It's formula driven. It's straightforward. It's very easy, but I want to walk you through it, okay? Because this method, while yes, it's statistical in nature, it's very accounting driven, because we look at it from the perspective of number of units produced and total cost. Now, high-low. What high-low simply means is there was a high point in the year and a low point in the year for both the number of units produced and the total cost. As you would suspect, there is a correlation between the total cost and the number of units produced. The higher the number of units produced, the higher the total cost is probably going to be. This opposite is also true. Lower number of units produced, lower total cost. So class, for those of you who are on the call today, who can tell me, out of the data in front of you, which is the high month? Which is the high month in terms of units produced and total cost? Which one is the high month?
May.
May, let's see, May. We got 47,000 units produced.
Oh, I'm sorry. No, not May, November.
Not May. So November, we got 67,500 units produced. So far that makes sense. 31,000 total dollars. Yes, May. Yeah, that's an excellent answer. Very well done. So December is our high month. What's our low month? Which one do you think is our low month out of the data in front of you?
I think that's March.
March? It goes lower than that.
February.
No, it goes lower than that.
Oh, June?
June.
Yeah.
June, we produced
Oh, June, yeah.
17,500 units, and our total cost was only 18,500. So that, yes, June is our low month, and our high month is December. Okay, so we have identified our low point and our high point. I want you to remember June low, December high. This data is going to come into when we compute it. Okay. So the variable cost per unit and the total fixed costs are also going to come into consideration here. So let me show you the high-low method. So November was our high month, 67,500 units, cost 31,000. June was our low month, 17,500, cost 18,500. 17,500 units, 18,500 cost. The first thing we want to do here is compute the change. The change means the difference. Okay? There's a change in cost and there's a change in total units. High minus low. High minus low. That's it. High minus a low. That's the change in activity. High minus low. The change in units is 50,000. The change in cost is 12,500. High minus low. High-low method. So, number one, we figure out the changes. Now we got to find this number 2, step 2. Find the change per unit. Change in the cost per unit. How do I do that? I take my change in cost, 12,500, divided by the change in the number of units, 50,000. So 12,500 divided by the 50,000 gives us a change of 25 cents per unit. Okay. Well, you're like, oh, Dr. B, that doesn't sound like a big deal. It is. Changing 25 cents means a lot. Why? Because a change in 25 cents per unit, when you're making 67,500 units, that's $16,875. Okay, that's why it's a lot, right? So now we know change in unit, 25 cents. We got to find our total cost because our total cost changed, right? So how do we find total cost? You might ask. Well, here's how it works. We take, I'm sorry, how do we find fixed costs? I meant to say, how do we find our fixed cost? We know the variable cost changed, 25 cents. How do we find the change, fixed cost? Okay, so here's how it works. We know the total cost at the high volume was 31,000. Okay, so if we took the 31,000, the high, and we want to find the fixed cost. So we take the 25 cent, so we write out the formula. Total cost, 31,000, equals fixed cost plus variable cost per unit times number of units. We don't know the fixed cost, so that's your X variable. I remember, right? Statistics. Dr. B, I hate stats. Yeah, me too. So X variable is your fixed cost. That's what we're trying to find. Remember, you could always work backward in some cases because sometimes you're going to get a question. They'll say, hey, I need you to find this. And it gives you all the rest of the data. Sometimes you got to work the formula backward. But let me show you it this way, okay? So total cost, as you know, is fixed plus variable cost. The variable cost is $16,875. Why? 25 cents per unit change times the 67,500 units at the high gives us a change of 16,875. So change in the variable cost per unit times number of units plus the fixed cost. We don't know the fixed cost. So you flip the sign. You take the total cost minus the variable cost to find the fixed cost, right? Remember, you can always work backward if you need to find the variable. So we take total cost minus variable cost equals fixed cost. It's just a matter of rewriting the formula. Remember, it's just like, think about the accounting equation. Who can tell me? What's the accounting equation? Tell me the accounting equation. Who knows it? You all should remember this from 201. From Principles 1, yeah? What's the accounting equation? Who can tell me? The accounting equation. Who wants to tell me what it is? Come on. Come on. I know you guys know this. What is the accounting equation? Come on. Who knows it? You're all still there, right? Who can tell me? What is the accounting equation?
Is it
Go ahead.
assets equals liability plus equity?
You got it. Yes. The assets equals liabilities plus equity is the accounting equation. Now, Sinead, How can that accounting equation be rewritten? What do you think? How can that accounting equation be rewritten? Assets equals liabilities plus equity. That's the accounting equation, right? So if I wanted to find out what is my liabilities, how can I rewrite it? It would be assets minus equity equals liabilities, right? That's how you can rewrite it. So assets minus equity equals liabilities. That's how you can rewrite it, right? Remember, in when you've learned the math, the order of operations, right? You remember the order of operations. You know that equal sign. If you want to rewrite an equation, all you got to do is take the positive, put it on the other side of the equal sign, make it a negative, and you can find the difference, right? That's how you find what's missing. So I want you to think about that because you'll encounter questions like that once in a while. It's like, oh, find this missing variable. How do I do that? Sometimes you just got to flip the sign by putting it on the other side of the equal sign, right? And that'll tell you what's missing. That's how we found fixed cost here. Total cost equals fixed cost plus variable. If we don't know what fixed cost is, we can find it by taking total cost minus variable cost to find fixed cost. Right? It's an interesting little trick, but it's a trick you should know because I promise you it'll help at some point in the future. So your total cost, $14,125 plus 25 cents per unit difference. It's the high-low method. Regression. I'm not going to have you learn regression analysis. That's insane. You can do it with a calculator. You could do it with Excel. I'm not going to have you do that. But I just want you to know what it is. The reason why we do it is to find total fixed costs and total variable cost per unit. And this kind of shows you the difference between the high-low method and regression analysis. Ultimately, they're the same, right? Because of the difference in the variable cost. Okay, I showed you a couple of different cost behaviors and different methods of factoring cost, right? That's what I just showed you. Now, I want to talk about the most important aspect of business. Okay, like this is the holy grail here, okay? This is what you all are here for. Contribution margin. Oh, it's a beautiful thing. It's a fancy word, contribution margin. Think profit margin. Contribution margin. Also known as gross profit margin. Similar. Yeah. It's a beautiful thing because it tells you the percentage of gross profit that you get from each sale of each product, yeah, of each unit. Very easy calculation. There's two steps, okay? Two steps to the calculation. First, you want to find the contribution margin per unit. Very easy. You take the sales price minus the variable cost per unit. Sales price per unit minus variable cost per unit. Okay? If our sales price, for example, is $100 per unit, and our variable cost per unit, direct materials, direct labor, factory overhead, is $70 per unit, that gives us a contribution margin per unit of $30, which is just like saying, hey, for every unit I sell, I make about $30 gross profit. Sweet. That's awesome, right? Yeah. Super cool. Okay. So that's contribution margin per unit. The other thing you need to figure out is the percentage. We call this the contribution margin ratio. The contribution margin ratio is a percentage that represents the percent gross profit. Okay. Which is very simply found. We take the contribution margin per unit that you got from that first formula, divided by the sales price per unit. So my contribution margin per unit is $30. 100 sales price minus 70 variable cost is 30. So contribution margin per unit is $30. My sales price is 100. So 30 divided by 100 is 30%. 0.3, 30%. So that's contribution margin ratio. If you're like ever investing in a company and you want to know if the company's profitable, and you want to figure out if they're profitable on a per unit basis, this is a quick and easy way to do it. So now that you know about the concept of the margin, contribution margin, also known as gross profit margin. Now that you know about the contribution margin, I want to talk to you about break even. Break even, as I had said earlier, is where you neither made a profit and you didn't make a loss. You broke even. Your net was zero. Okay? Your sales equaled your expenses. On your balance sheet, you remember the balance sheet? What's on the balance sheet? Who remembers? What's on the balance sheet? You can tell me. I'm sorry, income statement. Tell me what's on the income statement. Who remembers?
A balance of accounts.
I'm sorry, Shanae, I didn't quite catch all that.
The balance of all accounts.
On the balance sheet, yes. On the balance sheet, that is true. You have the balances of your assets, liabilities, and equity. But what is on the income statement? You remember? There's a top portion and a bottom portion. And the top portion is revenue, right? So on the top, you got your revenue, which is your sales, minus your cost of goods sold, equals your gross profit. And then on the bottom, you got your expenses. And then on the very bottom, you have net income. So revenue, which is sales, minus cost of goods sold, equals gross profit, minus your expenses, equals net income. That's the income statement. That's the how it's formatted. The reason why I brought that up is because when we look at break even, we need to know our sales, revenue, and our expenses. And it's where the company neither made a profit or a loss. We can express this in terms of number of units and sales dollars. So how many number of units I need to sell to break even, or how much in terms of revenue, sales, do I need to make to break even? There are three formulas, or three methods we can find to break even. One is the break even formula. The second is a contribution margin based on the income statement that I just talked about. And the third is called the cost volume profit chart. So let's take a look at the formula first. This is the most common, easiest method. Break even. First, we'll talk about it in units, number of units sold, and then we'll talk about it in sales dollars. First, number of units. This is the number of units I need to sell in order to break even. We take our total fixed costs. Remember, the fixed costs are the costs that do not change regardless of the level of output, and it's fixed for the year, right? Our fixed cost, in this example, $24,000, divided by our contribution margin per unit. There's that word again, contribution margin per unit. Remember, the contribution margin per unit is your sales price minus your variable cost per unit. Sales price minus variable cost per unit is the contribution margin per unit. In this example, $30. Remember, the sales price was $100 minus $70 in variable costs. So $24,000 was my fixed cost, divided by $30 contribution margin per unit. That means I need to sell 800 units per month to break even. Make sense? You all got that one, yeah? It's a matter of remembering the formulas. Peter, good, right? Cool.
Yes, sir.
Awesome, thank you. And now for the break even in terms of sales dollars. This is how many dollars of product I need to sell for the month. I take my fixed cost, $24,000, divided by my contribution margin ratio. Remember, the contribution margin ratio is your contribution margin per unit divided by your sales price. Contribution margin per unit is $30 divided by my sales price, $100, gets me to 30%, 0.3, right? Times 100 is 30%. So a fixed cost, $24,000 divided by 30%, or 0.3, gets me to $80,000 I need to sell per month in order to break even. That's the formula. We talked about it in terms of units and in terms of sales dollars. Such an important concept for every business student and owner and anyone in business to understand. You have to understand this concept. Because remember, if you can't break even, you don't have a business. Promise you that. You'll be out of business real fast if you can't figure out what your break even is. Okay. We can also figure out the contribution margin by looking at our income statement. Remember, our income statement has sales minus cost of goods sold equals gross profit minus our expenses equals net income. That's our income statement. We can take a few of those items on our income statement and figure out the contribution margin by looking at the income statement. Now, how do we do that? Well, sales. That's our revenue. Okay, sales. Our sales, in this example, and this is always at the top of your income statement, is $80,000. 800 units times $100 each. 80,000. Minus our variable costs. Variable costs, cost of goods sold. Okay. Our variable costs, cost of goods sold, also known as cost of sales, cost of goods sold. Variable costs are $70 a unit times 800 units that we sold is 56,000. So 80,000 minus 56,000 gives us a contribution margin of 24,000. Sales minus variable costs. Sales minus variable costs. Contribution margin. Sales minus cost of goods sold. Gross margin. Contribution margin. Okay, $30 a unit, 800 units, 24,000. minus your fixed costs, which are also 24,000, equals your net income, 0. Remember, break even is when you neither made a profit nor a loss. Your net income, 0. Okay? Sales minus variable costs equals contribution margin minus fixed costs equals net income. When your net income is 0, you broke even. If it's higher than 0, you made a profit. If it's lower than 0, you have a loss. But that's the concept of looking at it from a income statement perspective. Makes sense, right? Awesome. And I want to show you what it looks like from a chart. The chart, very straightforward, okay? When your total costs equal your total sales, you broke even. It's really that easy. Anything below that is a loss. Anything above that's a profit. When your total sales equal your total costs, you broke even. And that's what it looks like graphically. Don't worry, I'm not going to have you make any charts in this class. But I do want you to know how to read them. Okay, now, earlier I had said, very early on, when we talked about cost behavior, the sales price might change. It might go up or down. Okay, I could put it on sale, or I can charge some more. All right. When I change my sales price, that means I need to sell more or sell less, depending on what I do to my sales price. The same is also true if there's a change in the variable cost per unit. Remember, variable cost per unit is direct materials, direct labor, and factory overhead. One of those three things can change over time. They're not always going to be the same, right? Because I'm not always going to pay my hourly employees the same. I'm not always going to pay the same cost for direct materials. Might go up, might go down. Okay. So when those change, we have to adjust our sales price accordingly in order to keep the same margin per unit. Fixed costs might also change, right? Our fixed costs might be high, low, in the middle. They change, from year to year. Our fixed costs change. I don't always pay my employees the same. I don't always pay the same amount for rent. I don't always pay, you see what I'm saying? So when those things change, the break-even point also changes. Okay? So I want to show you how break-even changes. Fixed costs divided by variable cost per unit gives us the break-even in the number of units. Fixed cost divided by, fixed cost divided by our contribution margin per unit gives us our break-even in the number of units. So let's take a look. Based off of that information, 24,000 divided by $35 per unit gives me 686 units I need to sell to break even. Okay, this was revised. Now, the reason why it was revised is because there was a change in my sales price per unit. And that change is based off of a couple of estimates. I have optimistic, pessimistic, and most likely. Pessimistic means I doubt it'll happen. It might, but I doubt it'll happen. Optimistic means I mean, that's what I really want to happen, right? But what will probably happen is most likely. And so it's like low, medium, high. Another way of thinking about this. And as your costs change or your sales price change, the break even also must change. The formula is going to be the same, but you need to revise the break even based off of those changes. That's what this shows us. I can look at break even in a couple different ways. I can also apply break even in a couple different ways. This is another method of applying break even. This one's called the margin of safety. I want you to think of the margin of safety as a comfortable level, right? That's why I call it margin of safety. Comfortable level. I'm comfortable with a 20% margin of safety. I'm comfortable with a 20% margin of safety. That's what margin of safety means. I'm comfortable with that margin. So here's how margin of safety works. We take the expected sales, how much in terms of sales dollars I expect to sell, minus my break-even point in sales dollars, divided by my expected sales. So expected sales minus my break-even is 20,000 in this example. My expected sales is 100,000, which gives me a margin of safety of 20%. I feel that if I had a 20% margin, I would be safe. That's what margin of safety means. I can also compute income from my sales. How do I find my net income? Very, very straightforward. All you do is follow the income statement. Sales revenue minus cost of goods sold, or in this case, variable costs, equals contribution margin, also known as gross profit, minus your fixed costs, equals your net income. So you can find your net income or income from your sales amount. Sales minus variable costs equals gross margin, contribution margin. Minus fixed costs equals your net income. You can also find sales. Again, sometimes you got to work backward. You might be asked, oh, here's your net income. What were your sales? You got to work backward. So you take your net income and then you add in your fixed costs. Okay? You add in your variable costs. You work backward. That's how you find the sales. Just work backward. I can also look at if I want to make a profit. Okay, I love making profit, right? Sometimes you can be like, I want to make a certain amount of profit. What do I need to do to get there? How much do I need to sell to get there? This is how you do that. We call this dollar sales to get the target income. We take our fixed costs, 24,000 in our earlier example, plus our target income. Let's say we want our net income to be 12,000 bucks. Okay, that's respectable. Nice little profit. We want our profit to be $12,000 at the end of the month. Our net income. Great idea. So take your fixed cost plus your target income divided by the contribution margin ratio. Remember to find contribution margin ratio. We take the contribution margin divided by the sales price. Contribution margin divided by the sales price. And remember, contribution margin is your sales price minus your variable costs per unit to get your contribution margin per unit. I can also find my target income by determining the number of units I need to sell to get to it. So we take our fixed costs plus our target income, just like before. But the only difference here is we're dividing it by our contribution margin per unit. And this will tell us the number of units we need to sell in order to get $12,000 of net income. See, it's a cool method, right? Because if, like we talked about before, you want to make $100,000 for the year. How do I do that? I want a $100,000 profit for the year. How do I do that? This is how you figure it out. You do it monthly, annually, whatever, but this is how you do it. I could also figure out my target income by looking at my income statement. If I want to make $12,000 at the end of the month, end of the year, whatever, I can figure that out. I can say, okay, well, my target income is going to be $12,000. Let me figure out what my sales are going to be. Well, I got my fixed cost, $24,000. Okay, so $12,000 plus my $24,000, that's $36,000. $36,000 is of course, going to be my contribution margin. And to figure out my sales, what's my sales going to be? I take the contribution margin and I divide that by the contribution margin ratio, 30% or 0.3. And that will tell me I need to sell $120,000 to earn that $12,000 target income. Make sense? Again, sometimes you just got to work backward. This is the method of doing it. Okay, cool. Sometimes we look at break even in terms of sales dollars. We look at it in terms of number of units. Really, whatever method you choose or strategy you choose, there's different ways of looking at it. And this is what I'm going to show you here. So break even changes. It changes based off of changes in fixed costs, changes in variable costs, etc. So when that happens, we need to revise the fixed costs and revise our margins, right? Revise fixed costs in this example, 30,000. Our revised contribution margin ratio is 40,000. So to find the new break even in terms of sales dollars, we'll take the new fixed cost divided by the new contribution margin ratio. Now, not all companies just sell one product, right? So a lot of times you go to different, places, they have a lot of different products. So you might remember this term from your introduction to business class, or intro to management, or intro to business, whatever it's called. It's called sales mix. The sales mix represents the number of different products that the company sells, right? That's what a sales mix is. We can find break even using that mix of products. And we do that by applying ratio amounts to each product based off of their sales volumes. Let me show you how that works. We call it a composite number, composite unit. A composite unit represents all of the different products that the company sells. So I can find my break even in terms of number of units across multiple products. Okay, so if I sell more than one unit of a product, or let's say I sell multiple products, this tells me how many total number of products I need to sell to break even for the company. So let's say you have like a Macy's or a CVS or whatever. There's a whole lot of different products that they sell, right? So you can figure out the break even number of units you need to sell for the whole store to break even. And this is how you do it. Take your total fixed cost divided by the contribution margin for the composite units. And to find the composite units, we apply what's called a sales mix ratio. The sales mix ratio is based off of the contribution margin per type of product. Sales minus variable cost equals contribution margin, as you know, and we can apply the sales mix ratio based on those products, those different products. So we take the sales price, the sales mix ratio, and the total sales price. So sales price times the sales mix ratio gives us a selling price per category, if you will, or type of product. So I can find the sales mix in terms of using this method by taking the total selling price of each product divided by the composite unit to get the mix, the sales mix. It gets more complex than that, but to find the contribution margin per composite unit, we take the sales price per composite unit minus the variable cost per composite unit. Remember, a composite unit basically puts all the different products that the company sells together. It's composite, right? To find the break even in terms of units, fixed cost divided by contribution margin per composite unit. Yeah, it's the same formula. It's just using the composite units instead of individual units. And you do the same things for sales dollars. It works the same way. The formulas are all the same. Okay, just about done here. When you look at cost, volume, profit analysis that we just talked about, and with respect to break even, figuring out the number of units you need to sell, looking at target profit, looking at all of those variables. There are a couple of assumptions you need to make. Costs are either going to be variable or fixed. They're within range based off of that linear regression I showed you. They're within range typically. You know, like the monthly variable costs are usually within a small change, right? All units produced should be sold, and the sales mix is typically constant. Those are your assumptions. One of the last methods I want to talk about today, or last concepts I want to talk about today, is called the degree of operating leverage. Leverage is a really important concept. In theory, it's just the contribution margin, but the leverage typically tells us the company's ability to generate profit. Okay? The ability to generate profit based off of the number of sales. That's what degree of leverage tells us in reality. So we take the total contribution margin in terms of sales dollars, and we divide that by pre-tax income, which we get from our income statement. That gives me a degree of operating leverage. Usually anything above 1 is considered good. So operating leverage, here's the example. Sales minus variable costs equals contribution margin minus fixed costs equals the pre-tax income. So if we take our contribution margin divided by our pre-tax income, we have a degree of operating leverage of 3. We can use that degree of leverage to figure out the change in income from year to year. So we take the degree of operating leverage times the change in sales. Don't worry about this. I'm not ever going to have you guys do the least of squares regression. This is, again, more statistics, but it shows us how break-even works using least squares regression for number of units sold and total cost. You do this in Excel. It's an Excel formula. I'm not going to have you guys do that stuff. And the last concept to kind of mention is about absorption costing. This is really an advanced accounting technique that I just want you to kind of have an understanding of how it works. So absorption costing has to deal with the allocation of fixed and variable costs as they're absorbed into total costs. And that's really what that concept tells us. I don't want to go too deep in that. That's more for an advanced accounting course. And that, my friends, is the end of our discussion on cost, volume, profit analysis. Any questions, comments, concerns about break even, cost, volume, profit, any of those concepts we talked about? Okay, cool. I want to also remind you of the assignment that accompanies this chapter. So, chapter 21 homework assignment, just as before, mix of true, false, multiple choice. It's 5 questions. You have 2 attempts on each homework assignment and each quiz, as you know. The higher of the 2 grades will be accepted in the grade book. Now, one last topic we need to cover, and that's probably why most of you are still on the call with me, and I appreciate you hanging out. The midterm exam. Okay. The midterm. Okay. I'm going to show you the midterm. So, yeah, I'm that cool, right? I'm going to show you the midterm. I'm going to do it in the student view because I don't want you to see the answers. But I'm going to show you the midterm. So, hold on a sec. So, here we are. We're in Module 2. It's week 3. You've already taken care of chapters 17, 18, 19, 20, and 21. So it's 5 chapters for those of you keeping track. Those 5 chapters are covered on the midterm exam. Now let me show you the midterm exam. Now here's the thing. This exam is worth 20% of your total grade. Oh, Dr. B, oh my God, 20%. There's only 1 attempt. Oh, Dr. B, 1 attempt. It's open book and open note. Okay. Open book, open note. You can have as many web pages you want open. I don't care. Okay. I want you to do the best you can. And I want you to take your time. There's no timer. You know, I don't do that stuff. It gives me anxiety. So.
Me too. Thank you.
You're very welcome. Yeah, I have a problem with anxiety, and timers are definitely trigger that kind of thing. So I want to show you the exam, and I want to show you how it's organized. Okay, and it'll look just like this when you open it up. There are a total of 20 questions. It's a mix of true, false, and multiple choice. There are 3. There are 5 questions on the midterm exam that are math formula driven. 5 out of 20. Okay, that's not bad. So even if you missed all 5, you'll still pass. Don't miss all 5s. Don't do that. Remember, it's open book, open book, open book, open note. You can have as much time as you need. All right? It has to be on time, though. So you have to submit this by Sunday night. I cannot accept the midterm exam late. Why? I have to tell the university your midterm exam scores on Monday morning. So, yeah, don't be late, please. I can't accept it late anyway. So let's take a look at these questions in order. There's 20 questions, all right? The first question is, which of the following items does not represent a difference between financial and managerial accounting? Well, that's interesting. That question sounds like it's from chapter 18, right? Which is, I think it's called managerial accounting, right? It's talking about the difference between the two. It's got to be 18. Yeah, it's definitely chapter 18, I would say. Or is it 17? I think it's 18, right? So it says the difference does not represent the difference. Be very careful reading these questions. It says does not represent the difference. So in other words, it's saying which one of these don't fit the difference. Let's see. This one's pretty obvious, in my opinion. I'm not going to tell you the answer, but it should be pretty obvious. Just review the PowerPoint presentation from chapter 18. You will find the answers there because one of those 5 things will not be on that list. Hint, hint. Question 2. Labor costs are clearly associated with specific units of production. That looks like a typo. Units of production, because the labor is used to convert raw materials into finished goods. This is called, remember, the people directly working on the product. The people directly working on the product, they're the ones doing the work. Hopefully that one should be pretty obvious. They're directly working on the product. The people working on the product are directly working on the product. That's question 2, which I believe also comes from chapter 18. Question 3. If the beginning and ending work in process inventories are 5,000 and 15,000 respectively, the cost of goods manufactured is 170,000. What is the total manufacturing cost for the period? All you got to know here is the formula for total manufacturing costs. And you just got to plug in them numbers and you'll find the answer. Pretty straightforward. That sounds like, maybe chapter 19? It might still be 18. I think it's 19. But it might be 18. Kind of don't remember the actual chapter number, but it's around there. This one looks like an 18 probably, maybe 19. Question 4, true, false. Factory overhead includes selling and administrative expenses because they are indirect costs of a product. I don't think so. All you got to know is the definition of factory overhead, and you'll know that this is not true. Question 5. This is definitely chapter 18. It's got to be. Managerial accounting. Provides financial and non-financial information to organizations, managers, and other internal decision makers. All you got to know is what is managerial accounting, and you know that's true. Question 6. Job order costing. Oh, well, that sounds like chapter, I think that's, what is that, 19, right? Job order costing. Positive. That's got to be 19. Job order costing would be used for all of the following except, make sure you read that word except real carefully, and then figure out the best choice. Now, question 6, I'm going to caution you. I'm going to caution you a lot here, okay? Because some of these are not jobs, they're services. Well, I mean, technically they're jobs. They're jobs. Oh, here's question 6. Here's the hint for question 6. You need to know the difference between job order costing and process costing. Because one of these is a process. All of the other ones are jobs. Remember the difference between process order costing and job order costing. The one that's except is a process, not a job. So remember the difference between the two. Look at the definition for job order costing and look at the definition for process order costing. You'll figure out which one doesn't fit. Which one is not a job order? And that'll be the answer for question 6. I remember that one. That one used to be pretty tricky. Still is. Question 7. At the end of the year, the company found its overhead was underapplied by $2,500, and the amount was not considered material. Based on this information, the company should probably do something to cost of goods sold, but I will leave it to you to look at that slide, those few slides on underapplied and overapplied factory overhead, which I think was in chapter, was it 20 or was it 19? I forget. Question 8. The copy center pays an average of $12 an hour for the employees and allocates $18 of overhead for each employee worked. Direct materials, blah, blah, blah. Oh, this is definitely job order costing. What is the total cost that should be assigned to the job? That's job order costing. Take a look at the job order costing chapter, which is chapter 19. Right? I think it's 19. So we did job and process, and I think those were both last week. Question 9. Predetermined factory overhead rate. That sounds like chapter 19. Question 10. Period costs. That sounds like chapter 19. Question 11. Actually, that one might be 18. Question 11. What is this? Process costing. Chapter 20. Question 12. Process costing. Chapter 20. Question
I thought we
13.
were on 11. I thought we were on 11.
Yeah, we were. It's chapter 20.
Oh, that's process costing.
Process costing.
Chapter 20.
Yeah, which is process costing, right? I think it was.
Okay.
Do you remember?
Okay.
I don't
I'll
remember.
find out.
I hear that. Let me find out real quick. I'll tell you right now, okay? It was chapter, oh man, I think it was chapter 20. I'm just going to quickly, yeah. Yes, chapter 20, process costing. 19 was job order, 20 is process. So question 11, that's chapter 20. Question 12, process cost summary. That's chapter 20. Look at these are mostly definitions. Yeah. Direct labor and indirect labor are recorded respectively too. So this question is a little different. You got to know that difference between direct labor and indirect labor and how they're treated, right? And you'll find this in chapter 20. I'm pretty sure because it's talking about work in process, finished goods inventory. So that's probably chapter 20. Okay, let's take a look. Material consumption report. I think that's chapter 20. Might be 19. I think it's 20 though. Cost of units transferred to work in process inventory to finished goods is called cost of goods manufactured. Yeah. That's definitely 19 or 20. I think it's 19. Okay, this is from chapter 21. Question 16. A statistical method for identifying a cost behavior is the... We just talked about that. So, question 17. This is definitely chapter 21. It's asking compute the contribution margin per unit. We talked about that formula a lot today. So if you find that formula in chapter 21, compute contribution margin per unit, all you got to do is plug in the data, fixed cost divided by something. Oh no, sales minus variable cost gives you something, contribution margin per unit. Sales minus variable cost, contribution margin per unit. Pretty sure, right? Look it up. We just talked about it. So that's 21. Question 18. Chapter 21, contribution margin. It's talking about the degree of operating leverage. We just talked about that a few minutes ago. Question 19. Guess what? Chapter 21, cost, volume, profit analysis. CVP chart. The chart. Question 20. Guess what? Chapter 21, under absorption costing. So it looks like they follow order, right? So you want to look at chapters 18, 19, 20, and 21. There's 20 questions out of the 4 chapters, all right? So I want you to follow that order as you're working through the midterm exam because they go in that sequence. So think of it this way. The first 5 questions are probably from chapter 18. Questions 6 through 10 are probably from chapter 19. Questions 11 through 15 are probably from chapter 20. Questions 16 through 20 are from chapter 21. So 18, 19, 20, and 21, 5 questions each, and they go in order. Now remember, this is open book, open note exam, midterm. I want you to take your time on this, okay? Do not rush. It's worth 20% of your total grade. Do not rush. But I want you to start it like today. You can save it and go back to it, okay? So if you select a couple of questions, answers, click save and close. Don't click save and submit until you're ready. Mike, go ahead.
Which is this one of the quizzes or one of the tests?
Midterm exam.
Thank you.
It's due on Sunday.
Okay.
Good question, Mike. Yeah, midterm exam is due on Sunday, along with Chapter 21 homework assignment. So, in order to effectively study, pass the midterm exam, it's pretty straightforward. Review chapters 18, 19, 20, and 21. Don't spend a whole lot of time on each one. What I want you to do is take a look at the PowerPoint presentations, the exercises, and the homework assignment or quiz. You'll find similarities in the questions between the quizzes and homework assignments and the midterm exam. Little hint there. So just take a look, okay? I promise if you do those things and you go in the exact sequence I just told you, there's 5 questions from each of those chapters. 5 from 19, 5 from 18, 5 from 19, 5 from 20, 5 from 21. They go in order. So just focus on each chapter at a time. Click save and close until you've answered all 20 questions, and then submit it. It's due Sunday night. This cannot be submitted late. I cannot accept it past Sunday night. It's the midterm, okay? I got to tell the university how you did on the midterm. So it has to be submitted by Sunday night. Has to be. No exceptions. Any other questions, comments, or concerns?
No, I just want to thank you for going through that with us.
Yeah, my pleasure, Peter. Absolutely. Shanae, didn't you have questions about some formulas?
I don't anymore.
Okay. All right, cool. I'm so happy
Thanks.
that, yeah, my pleasure. If along with that comment, Shanae, anytime that any of you have any questions about the content, you don't understand a concept, whatever, email me, call me, set up office hours. If you need to set up office hours, the link's right here at the top in the classroom. If you need to call me, my number's on the syllabus. If email is always best because it goes right to my phone. I usually respond pretty quickly, unless it's something ridiculous that I'm too busy. But most of the time, I'm usually in bed by 10. So anyway, any other questions, comments, concerns? Okay, cool. Now remember, the Chapter 21 homework assignment, you got 2 attempts. That's due on Sunday night, and the midterm exam is also due on Sunday night. I cannot accept it late. Please don't even try. Just turn that in late. I want you to start it now, like today, like right freaking now. And I want you to start looking at each chapter, 18, 19, 20, and 21. 5 questions from each chapter. I promise you, if you look closely at those PowerPoints and you look at the quizzes and homeworks, you're going to see the answers there. You just got to know where to look, okay? Open book, open note. There's no timer, but it has to be submitted by Sunday night, by 11:59 p.m. That's got to be submitted. Because on Monday morning, I got to tell the university how you did. Good? You all, is that fair? That's fair, right?
Fair to me, sir.
Okay.
More than fair.
Cool. All right, y'all. I'll send out this recording as I usually do. As always, I want you to stay safe. Please wash your hands. That damn virus won't go away. Wash your hands. Stay safe. Wash your hands. Do all the right things. I'll see you all again on Monday at 5:30. Thanks so much for your time. Appreciate all of you. Have a wonderful evening. And if you need anything, you got me. Thank you so much.